Hello, and welcome to Quilterchieviot's Markets Uncut podcast, your weekly insight into the topics and issues that we've been looking into at Quiltercheviot. I'm Ollie Creasey, Head of Property Research here in London. With our regular commentator Richard Carter on the beach, and I must say he's picked a very good week for it, I'm instead joined by Chris Beckett, Head of Equity Research, to talk through some of the economic and macro data. And to take us on a quick tour of the pharmaceutical sector, I'm also joined by Sheena Berry, Head of Healthcare Research. Thank you both for taking time out of your very busy schedules to join us today. So, Chris, we'll go with you first as usual. Macroeconomic data feels relatively thin on the ground this week, to be honest, though I did notice a pretty strong GDP print in the US, which was then followed by some commentary that suggested, A, that this reduced the probability of a rate cut, and B, this is probably a good thing. Does that reflect your take on the situation? And perhaps give us your views on what to expect from both the US Fed and the Bank of England, bearing in mind that we are recording this on Tuesday before those numbers are published. So if you're listening later in the week, please go and look up the actual results and we'll see how Chris has done.
Thank you, Ollie, for putting me on the spot. I think, yeah, you're right. Last week was a little bit quiet. Lots of economic data this week, which would be interesting. And as you say, meetings for the Open Market Committee of the Federal Reserve in the States and the Monetary Policy Committee closer to home at the Bank of England. From an equity analyst perspective, economic growth is never a bad thing. Activity is good, growth is good. The trouble is that financial markets tend to look for different things at different times. And this year, the focus has been when are we going to get some interest rate cuts? So we're in a perverse world where good economic news is bad economic news. So the fact that the US had 2.8% annualized economic growth is actually pretty good for people in the US looking for jobs, looking for a pay rise, etc., or running businesses in the States. If you're looking for interest rate cuts at the margin, it's not so good. What will make the Federal Reserve cut interest rates is seeing weaker inflation data and weaker employment data. And actually, 5 minutes before the time we're recording this, we had job openings data in the States. 8.2 million available jobs out there, well above the number of people unemployed. So the labor market in America is still pretty tight. What the policymakers may focus in more on is the fact that inflation numbers have been coming back, particularly the core inflation rate. And we had the PCE deflator, a measure of inflation that the Fed tend to prefer to look at, coming down, maybe not by as much as they would like, but it is coming down. So I think what we're having is definitely a slowing economy, but not every measure of that economy slowing at the same rate. There are some areas which are holding up better than others. I don't think anybody was expecting the Fed to cut this week. They'll have a lot more information by the time they get to their September meeting. And that's what the market would expect, a quarter point cut in September. And at the moment, the economic data is suggesting that that's still well on the cards. Where it's slightly more uncertain is what the Bank of England do. There is probably enough evidence for the Bank of England to cut now, but there's also, they could make quite a convincing argument of the need to wait for another month to see a little bit more confirmation. So slightly less certain on the UK than the US, but by the end of the year, we would definitely expect one or more cuts from both central banks.
That's great. Thank you. So let's just stick in the US for the time being, where we've recently seen the effective coronation of Kamala Harris this week as the Democratic nominee, obviously a while to go to the actual election. That was pretty widely expected, but it has now solidified as an outcome. And we've also seen that her approval ratings have actually gone up fairly well as well, and her chances against Trump are improving, certainly compared to what Biden's were. But I suppose the big question is, does that change the outlook for investment markets at all, do you think?
I think it does to an extent. There are other things that matter more to investment markets, particularly equities and bonds that we focus in on. But the fact that it's now a competitive race into the US election rather than a real coronation of President Trump for his second term that we were getting close to expecting. So if you look at the opinion polls, some opinion polls are showing Harris in the lead, some are showing Trump in the lead. The latest one from the Wall Street Journal is showing 47 to 49 in favor of President Trump, but that's well within the margin of error. Some of the things that people look at is the favorability ratings um, for Kamala Harris, far better than President Trump. And that may be a leading indicator of where opinion polls go next. So, what in market terms people are talking about in terms of the Trump trade has unwound a little bit. And in terms of the Trump trade, the sort of things, sort of economic policies people are looking at, higher tariffs creating lower economic growth. Not quite so good for consumer cyclical companies, but those have been softening anyway. Looking for lower interest rates as policymakers react to those lower growth expectations. If you look at fixed interest markets, looking for a steeper curve. So probably inflationary if we have more tariffs, but also having a lower end as central banks try to stimulate that growth. One or two sector specifics, you probably get a stronger energy sector, a weaker renewable sector, preferences and focus of different politicians. I said the politics matter at the margin. Where we are in the business cycle, everything that we were talking about, economic growth, and where we are in terms of interest rate policy matters far more to us as investors than the politics. The politics is interesting. Some politicians are slightly more random than others and make our lives that little bit more interesting. But overall, we're still looking at a good economy and good companies will outdo anything that hopefully politicians can throw our way.
All right. In that case, let's stick with some of the more investment data. Um, it's pretty early days still in the half-year reporting season, but we have seen a bit of a sell-off in tech stocks already, and that seems to have also caught car manufacturers in its wake. Um, what's your view on what's caused that weakness, and has it done anything to fundamentally change the investment thesis for either sector?
As you say, we're fairly early days. We're in the thick of results season, looking at a lot of company reports every day right now. Both sides of the Atlantic, we're probably about a third through half year reporting. Right now, it's pretty good. About three quarters of US companies and about 55% of European companies are outperforming on earnings expectations. So profits are higher than analyst investors thought they would be. What we're seeing in absolute terms is about 8% profit growth in America for the average company, but only about 1% in Europe. And that sort of explains quite a bit about why US equity markets have been stronger than Europe so far this year. If you look at the sector skew, it is back to the tech sector that you mentioned, where far stronger earnings growth is expected. In fact, investors for this earnings season expect 38% earnings growth for technology companies in the States. So expectations are pretty high. If you meet them, great. If you don't, it can be quite hard. I think what you refer to in terms of where sentiment is, it's really been down to two companies. Alphabet, the owner of Google and YouTube, reported and slightly disappointed investors. Their core Google search business was doing okay, but we're not watching quite as much or not watching quite as many adverts on YouTube as maybe we were in previous quarters. So a little bit of disappointment there. And you mentioned the car industry. Tesla disappointed investors, whether it's a technology company or whether it's a car company, or can it be both at the same time? You probably have to listen to Elon Musk, not me, on the subject. But fundamentally, they're not selling as many cars for as much money as investors would like. So that transition to electric vehicles and the competitiveness of that market in terms of Tesla having to cut prices to stimulate sales isn't great for profits and isn't great for its own share price. This week is far more important in terms of the rest of the large cap tech sector. So we've got Microsoft, Meta, the owner of Facebook, Apple, and Amazon. By the end of this week, we'll have a far better take on how the earnings season's going for technology companies. But those big bellwether stocks really do affect market sentiment.
Thank you for that. I'll parrot back some of your words before. Politics is interesting. So maybe just a final question for a bit of fun. Starting guns have been fired on the Conservative leadership race. Are you willing to put your neck out and say who you think is going to win, or at least who you think is in the lead at the moment?
I think it's fascinating. I think we have to remind ourselves that the Conservatives lost and lost badly. And in American terminology, they can take a seat and shut up for 4 years. It's not really going to matter that much to investors. Um, it does matter a little bit. I think if you look at the strength of our democracy, having an effective opposition to shine a light on what the government is doing is overall a good thing. It generates better government and better decisions that do affect the economy. I think there is a difference in terms of some of the candidates. I think there's six declared candidates for that leadership. Um, Political parties tend to move towards their core constituency, their party members, their activists. So, in conservative terms, that means moving to the right. Electorally, that's not very clever. You look at the sort of governments that we've elected really over my lifetime, it tends to be centrist candidates. You look at where Tony Blair campaigned from, what David Cameron did in humanizing the Tory party, what Keir Starmer has done in how far he's moved Labour away from Jeremy Corbyn. By getting to that center ground and owning that, that makes you electable. It may be what the Conservatives need to do, but I don't think instinctively they're going to want to do it. Whatever your politics, I think they need to find somebody who appeals to the UK population more than any of the present candidates have so far in their political careers. But people can evolve, people can get better. There are one or two candidates who haven't had that much exposure yet. And yeah, it'll be interesting, but it won't really matter to government decisions for a few years, whichever way they go.
Good points. Thanks, Chris. And turn now to Sheena, who I've noticed has been particularly busy recently reading through those half-year reports from healthcare companies. I have to point out, Sheena, there was a bit of a theme in the notes that you were sharing around this week at QC. Do you know how often you use the phrase guidance raised in the subject line of your emails?
I'm sure it was used a few times. I think we can say that a takeaway from the results season that we've seen so far is that large cap pharmaceutical companies have generally been announcing good quarterly results, with a number beating expectations and raising guidance. An area in healthcare where there's probably more caution going into the results season included the life science tools space. So companies in this space sort of provide instruments and services used in scientific research and production. So there's more caution here. And the reason was the tool space had a difficult 2023. So there was COVID-related destocking, China weakness, and some cautiousness in large pharma and funding pressures. Now, these challenging market conditions are still persisting. So, results and commentary were key, really, in order to determine if an inflection point had been reached. And a company called Sartorius was actually the first to report, and the outcome there was worse than expected. But then last week, we had Danaher and Thermo Fisher Scientific. They both released, Q2 figures better than expected, and Thermo also raised full year guidance. So that was obviously reassuring. However, an area that's probably been a little more mixed is actually the medical technology space. So we've had a couple of interesting share price moves from some US medical technology companies. So Edward Life Sciences, that's a heart valve specialist. That company, the share price was down sort of 30% on the day it reported. And Dexcom, which is a company known for glucose monitoring devices, that was actually down over 40% on the day on the back of its Q2 miss and lowered guidance. So sentiment in the medical technology space, is lower. But don't get me wrong, there have also been some solid results from some companies in that space. So I suppose the theme for results within healthcare so far has been a little mixed, but I would say there's probably been more positives than negatives.
Yeah, thanks, Sheena. And by the way, I wasn't just taking a cheap shot there when I remarked on the level of consistency that we've seen in your sector. But that's helpful. Thank you. We kind of think of healthcare as a fairly defensive sector, and obviously we've talked a little bit about tech and consumer discretionary having a bit of a tough time recently. Do you think it's fair to say that healthcare's seen any share price reaction sort of coming off that tech sell-off? Perhaps we've seen investors rotating into pharma. Is that something that you've observed at all?
Yeah, I think, we have seen a bit of rotation, sort of into some of the more value names in healthcare and probably some of the less crowded names. Over the last 18 months or so, the big story really and focus within healthcare has been, the obesity market. And Novo Nordisk and Eli Lilly really were driving the narrative there. Both companies, have been big winners in terms of share price performance and premium valuations. So there has been, whilst we have seen some additional developments within the obesity space, that maybe contributed to, say, the likes of Novo and Eli Lilly's share price last week, I would have to say they were probably hit a little due to rotation. So we are also seeing a bit of rotation just within the healthcare sector generally as well.
Yeah, I'm glad you mentioned obesity. It means I don't have to bring it up because we can't these days have the healthcare analyst on the podcast without at least one question about the hot new topic of anti-obesity drugs. I did notice one of the things that you highlighted recently was a new product in Roche's pipeline that was also going to address this market. I don't pretend to know exactly how the pharmaceutical market works, but do you think we're going to see a lot of new entrants into it? And is this anti-obesity market big enough for everyone to take a healthy piece of the pie, or is someone going to lose out, do you think?
We're certainly hearing a lot about what's going on in the obesity space. I think at the moment, though, Novo Nordisk and Eli Lilly are leading the way. Other companies are working on, next generation obesity products, but they probably are still, a few years away from potential market entry. So but then also we've got Novo and Eli Lilly, they've also got obesity assets in the pipeline. So, both are really working on maintaining their leadership in this space. But really with the next generation drugs, companies will be looking at, different administration, such as oral drugs or injectables with longer durations, reduced side effects, better quality of weight loss, better efficacy. So Wegovy and Zepbound, they're Novo and Eli Lilly's lead obesity drugs that are currently on the market. So they're weekly injectables. So, we may hear about different modes of administration. And Roche has both an injectable and an oral compound in its pipeline, and actually recently announced some positive phase 1 data. But, there are a number of other companies that are evaluating obesity treatments. So just to name a few, you've got Zealand Pharma, Viking Therapeutics, Pfizer, Amgen, and AstraZeneca. They're all looking at the obesity space as well. They are at an earlier stage and more clinical work needs to be carried out. But, companies will try and fast track this to try and get to the market sooner. At the moment, demand is outstripping supply for the drugs that are available. Novo and Eli Lilly are trying to increase capacity to help address this. But, at the moment, given the demand, it does suggest that there's space for multiple players. But however, what will really determine, if there's space for all of these drugs longer term is the clinical data that the drugs produce. But, the weight loss market and the obesity space, that's an area I'm sure we'll continue to hear a lot more about going forward.
Thanks, Sheena. I'll be sure to ask you more questions on it next time you're our guest on the podcast. I think we will draw it to a close there. We've probably used up more than our allotted time. So thank you very, very much to Chris and Sheena for joining us today, and of course sharing your thoughts on those markets. Before we finish up, if there are any listeners out there with any questions that they would like to ask one of our analysts for a future podcast, you can, of course, put your questions forward to our team by submitting them via the weekly comments page on our website. And if you don't have a question, then other feedback as well. We do genuinely love to hear from you, and do try and take those questions and weave them into our future podcasts. Now, to stay up to date with our thoughts on markets and current issues, do please visit our website. That's www.quiltachieveit.com. And here you will see more of what we're doing at Quilter Cheviot, as well as be able to watch past webinars on demand and subscribe to this weekly comment, podcast, and the accompanying newsletter. So we'll be back again next week, of course. And in the meantime, for those of you on social media, you will be able to see up-to-date content on Facebook, Instagram, Twitter, and our LinkedIn page as well. But that's it for now. That's all from me. Thanks again to Chris and Sheena. And thank you to you all for listening. Bye for now.